Okay, Vibhav Kapoor, Group Chief Investment with IL&FS. He joins us live now. Vibhav, morning. Thank you for joining us. Vibhav, we lost we lost some direction on Monday, but the underlying strength is absolutely impeccable. Do you think more than local cues, the right thing to do in such market is to focus on global cues and global liquidity, and they both are looking quite constructive?
Yeah, there's global liquidity which is driving all the markets up. But I think more so US, Europe and Japan, and the rest of Asia is not performing as well, probably because of a lot of local reasons differing from market to market. The trend is definitely good. I think a lot of positive developments are happening at home in terms of lower commodity prices, lower oil prices, and now probably further reduction in interest rates going forward, with inflation numbers being quite positive. So all in all, definitely a reasonably good market and with reasonably good prospects. Having said that, of course, valuations are no longer that cheap, and there is still a lot of uncertainty going forward in terms of politics and in terms of corporate performance.
So what is the right thing to do in this kind of an environment where valuations are not supportive but liquidity is supportive? Should one participate, or fence sitters should still sit on the fence, or they should still remain on the sidelines?
No, I think you should look at stock-specific ideas, sector-specific ideas, and one should be investing, but cautiously. So there's no point in chasing the market, because liquidity can change very quickly at times, and sentiment can change very quickly at times if it is only because of liquidity. And you don't want to get caught on the wrong foot at that time. But if you have good stocks where you are reasonably sure that in the medium term they will perform well, and you've bought them at reasonable valuations, I think that's the thing to go for.
Right. How much more upside would you give to the market from here? Do you think that the market could be signaling getting into a new zone, given the expectations that the economy perhaps could be bottoming out?
Right now, the market, I think, is trading at about 14 times FY 14 earnings, going by our expectations of the EPS for that year. If liquidity continues to be strong and interest rates come down further and oil prices don't go up, if this current scenario continues, I think the maximum market can trade at about 15 times, which would take it about to the earlier high levels of about 63, 63.50. But having said that, I think the market would probably wait for at least one quarter results in FY 14 to really be able to sense that yes, we are going to get that 14-15% growth, which we are talking about. Because do remember that when FY 13 started, I think the consensus estimate for growth was in the region of 12%, and we are ending up only at 3 to 4%. So there is a scope of disappointments, and particularly, as I said, there are still a lot of issues in terms of politics. There are issues in terms of the capex not having yet kicked off at all, and a lot of issues on infrastructure investments yet to get kicked off. So it's in that sense still a narrow market, and there are a lot of sectors which are not participating, and if you really expect a really secular bull market to happen, then a lot of things must happen before that.
Okay, 144 points up for the Sensex. Reliance Infra today is contributing. IndusInd Bank is also contributing to the Nifty. Hindalco is contributing quite smartly. DLF is contributing. So it's not the good old pharmaceuticals or consumer names which are contributing today. In fact, Ranbaxy is down because there's a flash on your screen where Ranbaxy has admitted that the US export ban will continue for Ranbaxy till the time US FDA is not satisfied. And US, of course, is a big problem area for Ranbaxy. Minus US, it's very difficult to imagine that the company will do exceptionally well, because a typical good quality generic company derives nearly 35 to 40% of their profitability only from the US market. So with no US market and with no large blockbuster drugs, I doubt it very much that there is a serious case to put money to work into Ranbaxy when other pharma companies are doing exceptionally well. Ranbaxy also has a large institutional holding, so maybe you could see some institutional unwinding as well. Vibhav, I'm completely with you when you say that market valuations are looking slightly stretched and there are challenges in the near term. But at a time when the underlying driving factor is liquidity, do you think in the short term markets are likely to ignore core fundamentals? Because those who've only focused on value and those who've only argued this market based on fundamentals, guess what? None of those arguments have made money.
Well, I'm not saying, it depends on what type of risk appetite you have. If you're one of those guys who doesn't mind chasing the market and take a lot of risk, yeah, probably you can just go for it and go with the trend and then try and get out when the trend changes. But I think for investor who is prudent and who is cautious, it's never a great idea to chase liquidity beyond a point. And you need to be sure that the stocks you're buying are at reasonable valuations and have good prospects, so that if you go wrong because of sudden change in conditions in liquidity or elsewhere, you'll at least, you're sure that in the medium term you'll still make money.
Vibhav, everyone has a different definition for value. Let me hear out your definition for value. What is value in this market, and at what price point you would like to put money to work?
Well, normally, given the state of the economy, as I said, the fact that still capital expenditure has to take off, there are political problems, all these issues which are still there, I think around 14 times earnings for FY14 is a fair value, given the fact that right now consensus estimates are for about a 13 to 15% growth in EPS going forward. Now, if that changes, if your earnings estimates are upgraded to say 17-18%, then obviously I think the fair value would go up to say something like 15 times. But the average for the Indian markets has been in that 14-15 range for the last 10 or 15 years. But we must also remember that right now there are problems, or there are issues which the economy and the country is facing in the short term. So I would say 14 would be something I would be pretty comfortable with, but beyond that I think it gets into a sort of overvalued range.
Do you think, Vibhav, in this market, daring to be contrarian could perhaps not work very well as a strategy, so you ride the wave with the so-called defensives and the larger consumption theme than take risk in the cyclicals?
No, well, if you are positive on this market in the medium term, that's largely based on two facts. One, that interest rates will keep coming on down. So far, in fact, they haven't really come down. There's hardly been any pass-through of interest rates into the banking system. And second, that commodity prices and oil prices will remain low, and therefore there will be some margin expansion in some of the manufacturing and cyclical sectors such as automobiles and maybe a little bit in engineering. Defensives are already pretty expensive, and there is a visible slowdown in consumption, which is very evident by some of the results which have come in. So if you're really positive about the market, I think there's no point in putting too much money into defensives, because they will underperform the market, and you have to go in for cyclicals.
Vibhav, what explains the underlying strength in consumption stocks then? They are expensive, they've always been expensive, they will remain expensive, but if I look at a price action in a HUL, in ITC for that matter, even the smaller pharma, smaller consumer names, they are marching from strength to strength. Are markets telling us something special which all of us are ignoring?
I think there are 2-3 factors. One is that some of the longer term FIIs like pension funds, etc., are very confident about the very long term consumption story in India. So they keep on putting money there. Second is that investors who are not very confident about the market but want to be in the market still put money in the FMCG and the defensives, because they feel that anyway over a period of time these are relatively safe sectors to invest in. And third, of course, is the liquidity, which is anyway chasing these stocks and pushing up their valuations.
Vibhav, you've been in the markets for more than 30 years now. You've managed public money, you've managed private money, you're managing personal money. So how are you putting money to work at the current juncture? What kind of allocation, what is your current allocation?
Yeah, we are increasing, as I said, very selectively and very cautiously. We are increasing our exposure to cyclicals, to the banking sector, financials, and that obviously means automobiles largely in the cyclicals, and a little bit of the top grade engineering stocks like L&T, etc., because we believe that with commodity prices being down, there will be a significant improvement in margins in FY14 for these companies.
And what would be your view on some of the pharma names which have run ahead of themselves? Not particularly speaking about the way the defensives have performed, but do you think that in pharma, the research side could also see some traction than just the generic side of the business?
Pharma is, I always treat pharma not as a sector, but look at the company-specific issue there, because all companies have a very wide and a very varied sort of portfolio and varied business conditions that they operate in. They're research companies, they're generic companies, they're APIs and so on and so forth. So I always like to look at each bottoms-up approach on pharma rather than a top-down approach. A lot of these companies are doing well, of course, and I think quite a few of them will continue to do well. There's one other factor, of course, which we haven't talked about, and I think which is relevant to the earlier questions, is also on pharma, is the rupee. The rupee obviously is depreciating a little bit, and given the fact that the dollar is so strong globally, given the fact that we've had a very high current account deficit again in the month, trade deficit in the month of April, I think the rupee will depreciate from here onwards, and that has two implications. One, obviously, it is positive for sectors like pharma, but also it has an implication on capping the market at level at some point of time, because if the rupee depreciates further, there'll be a little bit of nervousness in the market.